Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about H.B. Fuller Company quarterly report. H.B. Fuller Company offers a diverse range of products and services across various industries. The company's product portfolio includes adhesives, sealants, coatings, polymers, tapes, encapsulants, additives, and specialty chemical products. The company operates through three main segments: hygiene, health and consumable adhesives, engineering adhesives, and building adhesive solutions. Within these segments, H.B. Fuller Company provides a wide array of products for various applications, including packaging, converting, nonwoven and hygiene, medical and beauty, durable assembly, performance wood and textile, transportation, electronics, clean energy, aerospace and defense, appliance, heavy machinery, and insulating glass. Some specific examples of the company's offerings include specialty industrial adhesives, high-performance industrial adhesives, products for commercial roofing, heating, ventilation and air conditioning, insulation applications, caulks, and sealants. The company sells its products directly to customers, as well as through distributors and retailers in multiple regions around the world. Overall, H.B. Fuller Company's extensive product range and global reach make it a significant player in the specialty chemical industry. H.B. Fuller Company maintains a market capitalization of $3 billion, broadly in line with the industry peer group. H.B. Fuller Company trades at a higher price-to-earnings ratio of 20 times and a higher price-to-book ratio of 1.5 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 61% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the company's financial performance. On the positive side, the acquisition of ND Industries Turkey has significantly contributed to revenue growth, generating $7,902 million in revenue. Additionally, mergers and acquisitions, M&A activities have also led to an increase in revenue due to the addition of various companies. Furthermore, higher product pricing has resulted in a higher gross profit margin, while a positive currency effect has also boosted revenue. On the other hand, organic revenue decrease has driven revenue decline, primarily due to sales volume decreases and increased product pricing. Sales volume decreases have contributed to revenue decline in various segments, while decreased product pricing has also had a negative impact on revenue. These factors highlight the importance of effective management strategies to mitigate revenue decline and capitalize on growth opportunities. Net income and profit margins. A year-over-year comparison between 2025 Cone and 2026 Cone, net income experienced a significant increase. It rose from $13.2 million to $21 million, representing a 59% growth. This substantial jump in net income was also reflected in the quarterly change, which showed a 3.9% increase. Profit margins also underwent notable changes during this period. The gross profit margin saw an impressive rise of 180 basis points, reaching 6.8% in Cone 2026 from 5% in Cone 2025. Additionally, the adjusted EBITDA margin increased by 3.8%, with a more specific increase of 90 basis points from 2025 Cone to 2026 Cone. The reasons behind these changes are multifaceted and attributed to various factors. Higher product pricing played a significant role in boosting net income and profit margins. Lower raw material costs also contributed to the improvement, as did the impact of acquisitions and restructuring actions. Furthermore, foreign currency exchange rates and fluctuations had an effect on the company's financial performance during this period. The company's financial performance indicates a significant improvement in its ability to generate positive operating cash flow. A comparison of the first 3 months of 2026 with the same period in 2025 reveals a substantial increase from $13.3 million to $21 million. This upward trend suggests that the company is effectively managing its operations and generating sufficient cash to meet its financial obligations, positioning it for long-term success. The company's debt level has experienced a moderate increase over the past year. As of February 28, 2026, the total long and short-term debt stood at $2,076.1 million, up from $2,016.9 million in November 2025. This represents a net increase in borrowings of $56.7 million in 2026, which is lower than the $166.8 million recorded in 2025. In terms of interest expenses, there has been a notable change. The liability for interest expenses increased to $3,882 at February 28, 2026, indicating a significant jump from an unknown previous value. Additionally, interest expense rose by $0.9 million, a 3% increase, due to higher debt levels in 2026 compared to the previous year. These changes suggest that the company's increased borrowing has led to higher interest expenses. Management is optimistic about the company's outlook, citing several key points. The acquisition of ND Industries Turkey and Taiwan is expected to drive growth in high-margin and high-growth market segments. This strategic move will likely have a positive impact on the company's bottom line. In terms of environmental matters and asbestos-related litigation, management is confident that these issues will not have a material adverse effect on the company's results. This suggests that the company has taken steps to mitigate potential risks associated with these areas. Looking ahead, the company plans to focus on growth initiatives, permitted acquisitions, and general working capital purposes through borrowings on their revolving credit facility. This indicates that management is committed to investing in the business and exploring opportunities for expansion. Finally, management expects cash flows from operating activities to be adequate to meet both short-term and long-term liquidity needs. This suggests a high degree of confidence in the company's ability to manage its finances effectively. Overall, these comments suggest a positive outlook for the company, with a focus on growth and strategic investment. The company has made significant moves through its acquisitions and divestitures over the years. In terms of acquisitions, one notable instance is the purchase of a business from a third party in 1976. This strategic move likely aimed to expand the company's capabilities and offerings. On the other hand, the company has also engaged in divestitures, which involve selling off certain assets or businesses. One example of this is the divestiture of its North America flooring business. This decision may have been made to focus on core operations, reduce costs, or realign the company's priorities. There are concerns about inventory buildup or supply chain disruption that warrant attention. One area of concern is the discontinuance of certain products, which can lead to a surplus of inventory and potential waste. Additionally, a decrease in sales volume coupled with lower raw materials costs may indicate an accumulation of inventory, further exacerbating the issue. The financial implications of these concerns are also evident. The company's net working capital has been affected by changes in inventory, with $27.5 million being used to fund inventory provision in 2025, and a source of cash of $13.7 million generated from inventory changes in 2026. These fluctuations highlight the need for careful management of inventory levels to avoid supply chain disruptions and minimize financial losses. That concludes the financial summary for H.B. Fuller Company. Feel free to comment below, and I will be happy to answer them when possible.